This is Lawrence Lotz, and welcome to the Wolf of Queen Street. Welcome back to the Wolf of Queen Street podcast series. Welcome back to the audio podcast or the video series. But before we get started today, I just want to do a shout out to my sponsors. Lighthouse Financial. They are a leading provider of financial solutions for business owners and property investors. They specialize in property investment. Investors wanting to grow their wealth via access to financial institutions, financial help, brokerage, and anything related to accounting. And they make the complicated process so simple and easy. I'm a client. I use them at the moment, and it's the most simple company to use for big decisions, and they help me out so much. And Lighthouse Financial is just the place to go for anything related to property or business in brokerage or accounting. And you can find them at lighthousefinancial.co.nz. And funny enough, today I've got the director of Lighthouse Financial, Matt Harris, back on the show, as I sort of have him every couple of, Matt, about every 2 to 3 months, I get you back on the show because we talk property investment, and in the New Zealand market, due to the government unsure about itself, due to the environment unsure about ourselves, there's so much stuff changing that I literally have to have Matt back on every sort of 2 to 3 months. I'll release the last show. Hey, Matt, and literally within like 2 weeks, Matt calls me and goes, Lawrence, I think we need to schedule the next one again because there's been so many changes coming on board. But anyway, Matt, welcome back again.
Thanks, Lawrence. Good to be here. Good to be back on your show for whatever number of times it is.
No,
and I get promised for people watching, I didn't buy my way onto the show.
I always have to have a bit of a dig at Matt and a bit of a laugh. So I was getting ready for the show, and I thought I'd actually brush my hair. I always give Matt a hard time about this. I thought I'd actually brush my hair nicely because I've always got to compete with Matt that's got the most amazing hair out there. So funny, I walked into my kitchen before the show, and my son looked up at me and, your hairs look nice. And I'm like, yeah, because normally on a podcast, I put a hat on, or I don't really care about it too much, but I've got to look the part. I actually want to throw Matt off a little tonight, and I thought, no, I wouldn't, because he reached out to me, goes, you know, how professional, because he's been on a few times, but we're obviously in lockdown, so a lot more casual. And I was sitting earlier, Matt, after we spoke, and I thought, okay, I might put a shirt on and a tie. Not that I ever wear a shirt and tie, but I was gonna put it on and start the show, and then just see Matt like squirm because he would have been so underdressed. But I knew that I didn't want to throw my guest off and make him feel awkward while we're doing the show.
Look, it's not often that I do this kind of thing in a t-shirt, so lockdown, different times.
Awesome. But today's show, Matt, I wanted to cover off a handful of topics that have changed since the last time we've met. Some of them is touching base on some stuff 6 or 12 months ago. But I'm just going to do a quick run through to anyone that's watching the show at the moment that's interested to see what the next 20 to 30 minutes and cover what we're going to go about. We're going to talk about, is property still a viable option from an investment? We're going to go into this inflation. What does it mean in the impact across your property? We're going to talk about, again, how does lockdown now that we're 12 months on, further since first lockdown in New Zealand, how does it really affect property investment? Because now we have a better understanding. We talk about this thing about rents. How will the rents go in with all the new legislation that's come into place? And underpinning under that is linking into the tax changes, some of the income changes, as well as the housing supply market out there. So that's a few of the things we're hoping to cover for the next 25 to 35 minutes. I hope you stay with us to enjoy that. But Matt, let's get straight into it as we always do.
Yes.
Is property investment still a sure thing?
Yeah, and so I think it's pretty good to frame this episode with that question to begin with, because it is one that I'm getting a lot more than I used to. So I think we can all accept that probably the heyday of property investment in New Zealand has passed. Mm-hmm. Having said that, without a doubt, it is still a very, very viable asset class. And there's a couple of things that property has going for it. Mm-hmm. And in New Zealand, obviously, there's a love affair with it. And I personally love it. I can't point the finger at anyone else because I'm as obsessed as anyone. But arguably New Zealanders could have a little more financial literacy in things like shares and bonds and other financial instruments that do provide a rate of return, which actually, if you break it down, is fairly similar to property over the long term. And as an asset class, property and shares are fairly similar. But property has one thing that in my mind sets it far apart from investing in the stock market, for example, and that's leverage. And most property investors will be aware of the power of leverage. But what leverage does is it drives up your rate of return exponentially, because all you have to do when you buy a property is put the deposit amount, which obviously varies between 40% and it can be as low as 10%. But the bank lends you the majority of the balance of the money, but you get to keep all of the gain. So leverage is one of those things that is a very, very powerful tool. When you put that together with property and the fact that property is a relatively risk-free investment when you invest over the long term, bricks and mortar has been shown to be quite safe. You get a good property, good tenant. You can pretty much rely on a rental income stream for the majority of the time that you own that property. And to be honest, most of the time when I see long-term residential investors go south, it's on a personal basis, a loss of job, a death, some other thing that's gone wrong. And that's generally what sinks investors. And ironically, that's the one thing you can actually insure against pretty easily. Life insurance, loss of earnings insurance, those sort of things are pretty easy to get nowadays. And you can pretty much mitigate all the risk in property investment. So if I was going to characterize property as a sure thing, it is an asset class that you can make a very good rate of return using leverage without taking an unacceptably high level of risk. So that's the first part of it, I think. Probably one thing more to add, and I think this is important, is that whilst property investment is getting harder, and you can tell it's harder because the governments are legislating more, banks are legislating more, and I will cover a little bit of that later in the podcast. But there's one thing that is true about the demand for property, and that is that land is theoretically finite and population growth is theoretically infinite. Now, I think both those things are probably not true ultimately. Land, obviously, in Dubai, they made a whole lot of land just in the sea, and in places like China, they control population growth. But ultimately, if you base the fundamentals, at least within our lifetime, those two things probably are true. And so I think property is a sure thing. And the only thing that I know being a little bit different is that if you came into my office 1 or 2 years ago with $100,000, you had no other investments, I would almost have certainly pushed you into a property, not because it was superior to shares necessarily, but because we could use leverage and grow your wealth at a faster rate. Now, if you come into my office with $100,000, it might be that within the next year, I can't put you into a property because that's not enough money. And I think that's what will change over time. The amount of money required to be a property investor to begin with will increase, and therefore other asset classes such as shares and managed funds, etc., will be the only option where property still would give you a higher rate of return.
Sorry to interrupt the current show, but just to let you know, if you're enjoying what you've seen, make sure you hit the subscribe and like button. So next time another episode comes out, you'll be able to see it first. Back to the show.
Yeah, it is an interesting time, Matt, and it's great information you provided there. So there's so many different other asset classes. Yes, the power of leverage allows you to take your $1. The bank gives you the $5 on top of it at their risk and no cost to yourself, and to go to invest in it. And I do like how you said about $100,000 2 years ago, you could get into the game, because I know there's people watching or listening at the moment going, "Hey, how can it still be a viable option? I can't get into it." When we're talking about, is it a viable option or is it still a sure thing? We're talking about it, if you're in the game or get into the game, will it still be a good investment option? And we're saying, yes, it is. Now, the thing to think about, what Matt said, is you might have to take a couple of different steps from 2 years ago to now to be able to get into that if you have some money. Do it in a different asset class, into shares, in different investments, to grow a bit further before the bank will allow you to do that. Just from, one of the strange things is I like shares myself personally as an investment. I have a different whole wide portfolio. I have different areas. And over the last 12 months, I have done the same percentage of growth in some areas on my shares as I did in my properties. Now, yes, I didn't have the power of leverage, but don't get me wrong, my $1 increasing by 25 to 35 to 40% over 12 months. And if I had $100 or $1,000 or $10,000, whatever in there, all of a sudden you've got that massive spike of growth, which might mean in that 12 months time, you've got that enough money to now get into the investment game. And it's just sort of those sort of options that Matt said, when you come to speak to someone like himself or his company, that will guide you down those paths depending where the market sits at the moment.
And there's a couple other options that are worth mentioning. And I like that you're in shares, because I also am, and you and I are both property investors, and probably our heart definitely lies in property. But the rate of return on my share portfolio is quite high. But without the leverage, it pales in comparison that the return of the property investments I have given me. But just as some quick alternative options before we get on to the next topic, there's the Bank of Mum and Dad, which is getting quite popular. There is KiwiSaver and first home buyer grants, which do make it a lot easier to get into certain types of properties, and we'll discuss that a bit further on, because the tax changes kind of made that a bit harder again. And then also the final thing is, which I do see from time to time, is actually people getting together, friends, groups of people pooling their deposits and getting in, and that does work.
Yeah, it totally does. So let's get into the next thing, Matt, to go through at the moment. Talk about inflation and its role on property.
Yes, inflation is something on my mind daily at the moment. And inflation is something that has been around basically since they created currency systems, and probably in real life when the gold standard was removed, and basically all countries went to fiat currency, which is currency backed by the government. And there's probably people out there who are like, let's all get gold because fiat currency is just fake. But I mean, if you think about financial systems and asset growth and even capital value on property, it's all fake until it becomes real anyway. So I don't necessarily buy that argument, especially because if the world crumbled and someone came to me and said, "Here, take my gold and give me some food," I'd be like, "Oh, I don't need your gold." But inflation is one of those things that both helps and hinders property investors. So the target for inflation in New Zealand is about 1.8. But it's meant to be under 2% a year. Currently been running in the last few years annualized at about 1.8%. Of course, some things inflate more than others, and obviously we've seen in the property market that has inflated, and that's a demand thing, which we'll touch on later. But what the government does to deal with inflation and grow and shrink the economy is obviously manipulate interest rates on lending. So low interest rates help investors, but they also hinder them because they drive the demand for properties up. High interest rates hurt investors, but they also help them because the demand for property is a bit lower. So when I deal with clients trying to build portfolios and just thinking about property investment conceptually, and I probably don't do this with the one or two property owner, I wait till they've gone through a bit more complexity. What we've got to do is we've got to factor inflation into our rate of return, because whilst our capital growth rate is increasing, we need to minus the inflation. One thing I think is overlooked and is quite important, especially in a really high inflationary environment that we're in right now, and I think most people watching this, would have noted that the cost of a lot of items is increasing quite rapidly. And I believe that for this quarter, inflation is actually running at 3.3% in New Zealand, which is far over the target. And one thing I do like about property investment is that if I decide to go and buy a property today and I pay $1 million for that property and I get a loan for $800,000, I'm a long-term property investor, so I'm 8 to 10 year time horizon, but technically the loan is actually spread over 25 to 30 years. My property should rise, all things being equal, at least in line with inflation. But supply and demand factors are going to drive that probably a little bit higher. But my loan, I've locked in at today's rate. When I pay that in the future, I don't have to inflation adjust those dollars. So buying a property in a high inflation environment is actually a double win, because you win on the capital growth, but you also win because the value of your dollar in relation to that loan is not adjusted, whereas the value of our dollar otherwise is constantly devaluing as inflation goes up.
Correct.
And I think one final thing, which is interesting because New Zealand's done it for the first time ever last year, is quantitative easing. Countries worldwide print money now as commonplace. So it's one of the levers that can be pulled to basically help economies. The other is taxation. No one wants to do that, although New Zealand's done a bit of that as well. So I think we're sort of in the middle, a little bit socialist here. It's austerity measures, so spend less. No government's ever going to spend less, and people don't want to spend less. So by default now, money printing is part of the Western society and probably the whole world's economic and monetary system. And I think if you're a property investor and you buy fixed assets, as long as we remain in the system that prints money, you're going to win. And that probably goes with number one, is property a sure thing? And I can't say that it is, but it's still a thing, definitely. And inflation helps you, and money printing helps you.
It does, and it's something that people. I love how you said it. It's something people forget about when you've gone down the path large enough to realize that inflation does play into the spectrum, not in sort of the small-time investor, but the large investor. And there was another thing you said about there's the double win of a high inflation market, of buying that every day your value is actually going up and the dollar is getting further away. So the equity that sits in that property. It's just amazing. I remember a gentleman I used to work with a handful of years ago when we had sort of the last Auckland boom. I can't remember, Matt. That was 5 years
2011.
or 6 years ago.
2011 was a big one, and then another one in 2016. No, 16, 18 was really flat. So it was 2011 was the last big boom.
Yeah, I know it felt like a few years ago, and it's actually 10 years ago. But I was talking I was talking to a gentleman, and he was like talking about Herne Bay. Now, obviously, Herne Bay is one of still the top 3 most expensive suburbs in Auckland, maybe one of the most expensive suburbs in the country. And he was talking to me, and he was like, "Lawrence, I'm considering doing a white knuckle move." And I'm like, "What are you talking about?" He's like, "I'm considering buying a place in Herne Bay and white knuckle and holding on for it for 6 months, because the growth and the inflation and everything else is so drastic that in 6 months' time, as long as I can cover my arse for 6 months, the growth is just exponential." And then he goes, "Then I can release and get rid of it and make off the investment." Obviously, 10 years ago, we had a lot of different tax laws that don't exist. There was a fewer laws that exist today, so you could do that short-term buy and hold and stuff. And I looked at him and I said, "Hey, it's a great idea," but it's still at that stage. It was still $1 million suburb, and he was talking about white knuckling $1 million. And to me, as a small time player 10 years ago, I was just like, Jesus, imagine like white knuckling $1 million on investment, hoping you can cover the mortgage for 6 months. I was just like, and now 10 years later.
He'd be killing that. The rates were about 6.5% at that stage. It's probably a lot of money, and obviously we earned less as well. But I guess that brings me to a really good point, because as you grow as a property investor and you climb the scales of complexity, is how I like to describe it. What you realize over time is that periods of vacancies or plots of land that you're going to develop or you're halfway through developing, the fact that you're not necessarily deriving a rental income on that doesn't mean that you're not getting that rate of return, because rent is just one part of a wealth creation cycle, or the wealth wheel approach. I've called it on this show before. Or it's actually incremental gain over time, all the jargon coming out. But ultimately, you can have periods and properties that are unrented, and a real good example, which I see in my office a bit, is beach houses. The laziest asset in the land, but most have had quite good capital growth. So there you go.
Awesome, Matt. I just want to get on to the next thing. It's something we actually covered off over 12 months ago when you came in again a few episodes back, because you've been on so many. And we spoke about at that stage when we went into the original first lockdown in New Zealand and the impact of COVID and how it's going to work and everything else. I want to cover all this off again now, because now we've obviously 12 months later, way more than 12 months. We're currently, as we're recording this, we are still in level 4 lockdown in Auckland, with a shift of movement in the rest of the country over the next few days. How is COVID lockdowns affecting the property market currently? And from what we've seen in the last 12 months, sort of the impact of the next 30 to 60 days from here on forward?
Yes, I love this question, because it's not what you think. And I'm going to start by saying the other thing that helps us as property investors is lockdowns. And I hate lockdowns. I am fundamentally opposed to it, and I'm also quite a busy and social person, so I like to be out and about. But the fact that we've had a lockdown probably resulted in a 0% rise to the official cash rate.
Correct.
So what that has done, obviously, is helped property investors have lower interest rates for a bit longer. So rate of return is going to increase for a little bit longer, but it's twofold as well. So there's quite a few other things that happen. Interestingly enough, in lockdown, the demand for information and or searching of property increases by about 40 to 50%. So part of that I put to boredom. It's probably a lot of people with time on their hand. But other than that, I think having gone through one lockdown already, one proper lockdown, obviously, and then another smaller one, and realizing that the world's not going to end and that actually it's not that detrimental to our economy, which has been going pretty well, probably on the back of a lot of government spending. People are obviously open to looking at properties and buying properties. And I think when we come out of lockdown, we're going to see another little mini boom. The other thing that happens, though, as part of a lockdown, which doesn't help, is that there's quite a bit of uncertainty. So people who might have sold a property will not put it on the market any longer, or they'll hold off until there's what they determine to be certainty. And who knows what certainty regarding COVID is going to look like, because it doesn't seem like they've got any strategy really to get us to certainty. So those who deal with uncertainty probably doing really well, but those who don't put their houses on the market. So we've got this very, very funny problem in New Zealand where we already don't have enough supply of property, but we've got really high demand for it because interest rates are low, and as an asset class, it provides pretty much a good level of return for low risk, as we already explained. And people are also not selling, so we've got a double constriction of supply. We've got less listings than ever. We've got more people looking for property than ever, and also we can't build property fast enough. And lockdowns, obviously, no builders are on site. I can tell you, my development right now, no one's on site. That is now 4 weeks behind by the time we're out of this. Every development in New Zealand is going to be, every development in Auckland is going to be 2 weeks behind. In New Zealand's going to be 2 weeks behind, and every development in Auckland's going to be a month behind. So this funny thing, the psychological impact of COVID is not does not spill out into the property market as readily as it does into something like tourism or small businesses, which really struggle. And the final other thing that probably should have been mentioned as part of the inflation part is all these supply issues and this lack of supply. What it does is inflates the sites that you have to buy. And we're going to cover this in the tax bit because there's a direct unintended consequence, or maybe they knew about it, that's happened as part of the tax changes. But what also happens is that builders and property developers do what I call risk-based price gouging. So placemakers, about every month I get something from placemakers or carters saying we're getting 8% or 10% or 20% on this. Not all of that is a real gain in the cost to the supplier. What it is it's risk-based. So it starts at the production end and it goes all the way through the value chain to the supplier, and then all the way through to the builder, and then all the way through to the developer who sells the property. Property's uncertain. COVID's uncertain. Interest rates are low, but how long? Government is legislating left, right, and centre, and also climbing into the property market trying to build houses. So we're seeing this kind of level of risk that price gouging COVID also drives that. But ultimately, I think COVID helps property investors. Lockdowns help property investors, but to a point.
Yeah, it is. It is an interesting one, Matt. Obviously, going through it, I did investment personally through last time's lockdown. I got caught by when we went into our main one. I had to drive a day before to into a property to check on it, and then my property was vacant through the first big lockdown we had in New Zealand. So I had to sit there, and this property was hours away from my own personal home. So I had to sit there and just go, hopefully my insurance covers me if I get there and the house is not standing anymore, because
Yeah.
it was something like 4 to 6 weeks. There was no one was allowed to the property or so forth.
Yeah.
And then we obviously got through all of that, and in September, October, the whole FOMO came in, and everything went up. And like you said, now we get into it, into the next lockdown or the next moment we're living in, and people are realizing, look, yeah, this sucks. Don't get me wrong, lockdown sucks. We've got to do this. We've got to control some stuff. But there's none of that FOMO is out there, but still there's the opportunity. So investors are still getting into it. And what I think is happening more in this time is investors are still playing the game because they know the knowledge what they need to do because they paid attention last year. So those guys and girls that are playing the game are still playing the game. And some of the people sitting at home now that have the opportunity because they've got more time are doing a bit more research. And therefore are also stepping up to it. So it's not buying from over FOMO fear, but it's buying because, hey, I've got the opportunity and I've been educated enough through the last few months and getting into it. And I was speaking to a real estate agent the other day when we went into sort of the first week or 2 weeks of the current lockdown. How you doing? And they were like, it's crazy. I sold 3 yesterday. I sold 2 today. I've got another couple that's interested in a few days' time. And they were like, the month beforehand, there was nothing when we weren't in lockdown. But as soon as we got into lockdown, it's just so much movement. So it is such an interesting space that it doesn't get affected, or at the moment, doesn't really get affected through COVID.
No, I totally agree. I think it's because the professionals, real estate agents, property investors, developers, they know the psychology of a lockdown now, that demand is going to spike. And I've been to a few auctions this week virtually, and I tried to buy a couple of properties, which I thought could be the go because it was lockdown, but not a chance. Every man and his dog was on them.
Yeah. It is crazy. I must say, to anyone that's on social media that loves their TikToks and Instagram reels, I do love the ones that are floating around at the moment where the guys play around, going to an auctions, thinking they got an option. There was a viral one a handful of months ago. I don't know, Matt, if you saw it, and it was a very good explanation of the first lockdown FOMO. And it was a guy selling an apple. I don't know if you saw this one.
No,
and a guy comes up in the video. Obviously, he plays 5 different characters, and he's all himself. Though he's like, "Hey, I've got an apple. It's $5." And the guy next to him goes, "Okay, I'll give you $5." And then he goes, "No, but I want $7 now." And then a guy on the other side of the room goes, "But I'll give you $10." He goes, "No, keep going." And then someone turns around and goes, "But it's just an apple." And it was like, that was the whole realization of sort of last year. And unfortunately, a bit of the chaos that it is now. It's not as chaos now. It's a bit calmed down a bit. So but going into the next part, Matt, this is a bit of a chunkier part with some more pieces into it. But the fundamental, simple question would be, a lot of people want to know, due to some of the changes and all that stuff, is what is the impact, or what do you see the impact going to be around rents going from this point forward of the next 6-12 months into 2 years?
I think so. My prediction, I've made it a couple of times on various podcasts and other things, is that rents will rise 30% over the next 1 to 2 years. I actually think I'm wrong. I think I'm going to be wrong. I think it's going to be more like 40%, probably higher. And to give some context to the people watching, there's some very good reasons for this. So first of all, the government back in March have come in and made some pretty drastic tax changes, which I don't think were the right thing to do, because they've targeted the demand side, not the supply side. And we've already explained that supply is an issue. But what they've done is they've said, if you buy in situ property, so that's a property that's already built, and you cannot claim interest deductions anymore. If you own in situ properties, you still can claim, but it's going to be phased out over 4 tax years, 25% a year effectively. So what that does straight away is it segregates a certain asset class. So property assets come in lots of different classes: commercial, apartments, townhouses, in situ. But when we deal with them as residential property investors, we pretty much say in situ or new build. Right? Those are the two that we deal with. So now we've got a situation where the government has said in situ you cannot claim interest, but what they've also come out and said is if you buy a new build, you still can. So this bit I kind of agree with, because supply is an issue. They want more supply. Well, how do you incentivize supply? You incentivize people to buy a new build. If there's not enough new builds in the market, then a market theoretically will create them. So property developers are trying very hard to create them. But of course, there's a bit of a problem with that, because the reasons for buying an in situ property and buying a new build are quite different. And in situ is generally easy to add value, get more land, but it's higher maintenance and generally higher costs. New builds are generally the domain, well, they used to be predominantly the domain of a first home buyer. And that was for a couple of reasons. Deposit threshold is a lot lower. You only need 20% when you buy a new build. Sometimes 10% if it's owner occupied, but 20% if it's investment, as opposed to 40% in situ. Also, they were easier to buy because you didn't have to go to an auction to compete with the old Apple analogy you've just used. That didn't generally happen. You sat with a salesperson, or you went direct to the developer and you signed a contract. You had time to go get KiwiSaver sorted. Someone like us would do a mortgage for you. We'd get it all tied up really easily, and life was good. Now, of course, property investors are going, okay, well, I've got a lot of in situ properties. I've done very well. Capital growth's been very high. What am I going to do? I'm going to buy some new builds, and I'm going to get interest deductibility and balance my portfolio, which is totally sound thinking. Now you get a developer and demand, trust me, demand has gone through the absolute roof for new builds. Developers get 10 to 20 contracts per property. Right at the top is about 5 unconditional property investors. 5 below that might be the start of the first home buyers. So why will rents rise because of that? Well, first of all, if you're a mum and dad property investor, which by Statistics New Zealand counting is about 70 to 80% of all residential property investments in New Zealand, you probably can't afford to not have an interest deduction, because what happens is when you don't deduct interest, the tax profile changes quite drastically. Your net profit increases by the amount of the interest deduction, but you still have to pay the interest deduction. So that doesn't disappear. You still pay the bank the interest. Now you have a tax bill that's equivalent to probably about a third of the interest. So what's going to happen is that mum and dad investors, and it's already happening, is they go out there and they go, well, I need to increase the rent. I have no choice because I can't actually afford this because I'm a salary and wage earner. My wages aren't increasing as fast as inflation, but also the things I have to buy are reducing the buying power of my wage. So I can't do anything about it. Here, tenant, I'm sorry. Here's a rent increase. And on top of that, most of those landlords have just been through healthy homes as well. As you'd be aware, that's cost quite a lot of money that wasn't passed on to tenants. Actually, quite a lot.
I'm not in my head, mate. I'm going through it. I'm not in my head. This isn't small chum change. This is most properties. No. It's quite expensive.
It's significant, and I mean, I've had to go through it obviously, and my clients have, and it is actually quite significant expenditure that hasn't already been passed on. So, simply put, mum and dad property investors, which make up the majority of those investor group, and I refer to them as mum and dad investors. Not in a derogatory manner. It's just a group of people. They might not even be parents, but they are basically salary and wage earners, professional or otherwise. They build a portfolio for passive wealth creation. They're not out there trying to change the world, but they do have most of the housing stock. So that's going to occur. And what will happen is it will start with those people, and I think it already has. And then the market will do what markets do. And I love the market. I love free markets. I'm a big believer of it. They adjust. And it will just start to spread. And when you go to rent a house again, the rent appraisal will be a reflection of all the rents that's already been gone up in that region. And then it will continue because interest rates are probably going to rise at some stage shortly. So an interest rate rise doesn't help an in situ investor. It makes it worse. So I think that's fundamentally why. Outside of that, we have this big shortage of new dwellings and probably shortage of houses being sold in general, as we've already discussed. So anytime supply is constrained, back to the free market again, what happens? Demand goes up. If demand goes up, prices go up.
I totally agree with that, Matt. It was, I mean, to anyone that's coming on to this episode for the first time and interested about what we spoke about, myself and Matt, if you look on the show, we covered all the legislation that the government announced early part of the year. And it was at that stage we already said, rent rises was a given. These rules that they're implementing, fundamentally, it just means that the people that they're trying to impact, the investors, all they're going to do is they're going to counter it against the rules and increase the rent to make sure that we can still get it covered. I mean, yes, I think I've worked out with a lot of people. It's like $30 to $40 to $50 a week on a standard rental. It will make a difference, or we'll cancel that out. Now, it doesn't seem like a lot, but the person that's renting that house, straight away, if you just say to a renter, hey, I'm going to increase your rent $50 a week straight off the bat, if their current rent's 500, 700, 800, doesn't matter. It's still a decent chunk to take up straight away off the bat. So as people are coming off contracts at the moment, there's that impact. You said about healthy homes, large costs, the interest rates are coming. Those are going to increase. So the rents are definitely going to go up. So it is an interesting time around that space as well.
Yeah, and I think the double-edged sword for an investor who has to raise rents is that they have to do it because they can't afford it, but it also increases their tax bill. When I look at the new rules and I go, okay, well, who wins here? It's definitely not first home buyers, so they're probably going to be paying rent, which is going to be increasing. They can't buy the new build because the property developers got that. No, not the property investors got that. The only real winner here is property developers and those in the supply chain. And it's going to take quite a long time for supply to increase to the point where the rules have probably what the policy was intended for, the effect that the policy was intended for. But hey, we'll see.
It's such an interesting one, Matt. There's a question I want to throw in there, but I think we'll be going for another half an hour, and I'll leave it at that because, like I say, I always get Matt back every couple of months anyway. And sort of the subtle question that I want to leave people to think about, and it's something a lot of people raise, and Matt, don't answer it because we won't go down that path. But it is, at what stage do we expect people to dump their property on the market because of this impact, and they're unable to actually change their numbers from a mom and dad investor to catch themselves up? Because there is a consideration that those mom and dad investors, when the changes come in, the small changes are just coming in September, and it changes every year after that. There's a thought that in 12 months from now or in 18 months from now, we're going to see a dump in the market. Doesn't mean the market's going to dump, but it just means it could be a bit of a stock spike in there. But I'll leave that thought for the next time, Matt. You come on the show, we can cover that off.
Good. I'll think about that for a month.
But awesome, Matt, as always. Matt, where can anyone at the moment reach out to you? Obviously, to anyone that's watching, as I said, it's Lighthouse Financial, so the name's on the show, or if you watch on the YouTube and everything else. But if anyone wants to reach out to you direct or anything else, anything differently, how can they do that?
Yeah, look, I love to talk to property investors and business people in general. So obviously you can find me on the website, lighthousefinancial.co.nz, but also I'm on LinkedIn. I'm on Instagram. If you're an Instagram person, feel free to follow me, and you'll get a bit of a mix of entertaining things and me looking at property. And probably, obviously send me a text, give me a phone call. Always open to chat. So.
Awesome. Thanks, Matt, again for coming back on and covering it off. There's such important insights into there. And to anyone that's watching or listening at the moment, please, as always, just reach out and drop a comment or send something to myself or Matt if you've got any questions. I'd love to know your thoughts about it and where you stand. As much as we talk about investment in property and so forth, it doesn't mean we're always on one side of the coin. If you're on the other side of the coin as well, by all means, feel free to give your thoughts and considerations. I'm always open to having discussions on both sides of it. And see how it goes from there. And if you think there's somewhere, or there's a loophole, or there's an opening, or there's something that we've got to push further on to get changes made, let's have a chat and see if we can go from there. But at the end of the day, Matt, as always, thank you so much for coming on the show, and to everyone else, thanks for supporting. And if you enjoyed it, make sure you hit the likes or subscribe wherever you are, whatever platform you're on as well. But fundamentally, at the end of the day, we're doing lockdown. Stay safe out there. Think about other people. And at the end of the day, stay safe, beautiful. Until next time, see ya.